Chapter 2b. We hear this term flaunted around a lot of the time, mortgage, to mean a loan we get from a bank in order to buy a property. Since we are en route to becoming financial specialists, we ought to rectify this misconception. A loan to buy a property is the definition of a residential home loan. A mortgage, on the other hand, comes from the French word mort, which means death, and gage, which is the sort for engagement, engagement, or commitment. So a mortgage in effect is a commitment that dies when fully repaid. A mortgage technically, however, is the security offered in exchange for the loan, or the collateral, or the guarantee in case of default. In all times, the security offered would be the deed of the property. But since it's costly and risky to store many of those, banks simply started registering a charge on the property with the land registry. Think of it like when you rent a car with a debit or credit card, and the company puts a hold on a certain amount of money. They reserve the right to take it if things go wrong. So, when the security is signed over to the lender in exchange for the mortgage, the transfer of ownership is called the assignment. So there are two main ways in which a mortgage can be repaid. The first one, or the most popular one, is capital plus interest, taken mostly by people who buy a property in which they will live. The monthly repayment is split between interest and the principal borrowed. In the beginning, more of the repayments go towards the interest, and the longer you go, the more balance shift towards the principal and less interest. If the interest rate changes in the middle of the term, however, on a variable rate mortgage, the monthly repayments may increase. The second type is interest only. The interest is calculated over the entire loan period and then it's split evenly. The entire monthly payments go towards interest, which leaves the borrower on the hook for the entire amount at the end of the term. This is popular with people who assure a method for paying it off at the end of the term with readily available cash or a life assurance policy. Let's take an example. You decide to buy a £120,000 property, interest only. You take a mortgage for 1 year at 10%. This is how it looks like. You have 12 monthly payments of £1,000 each. That's the equivalent of 10% of the total mortgage divided by 12 months. And then on the last month, you have to pay an extra £120,000 to pay off the mortgage entirely. Because in an interest-only mortgage, one is only paying back interest through the term, the repayments are usually low compared to the capital plus interest one, which makes it very attractive to some people. This also works with the fact that house prices have dramatically increased in the past 4 decades, leaving that as the only option for some people to get on the property ladder. The MMR, Mortgage Market Review, came into effect in 2014 to ensure borrowers adequately checked people had credible repayment strategies for the interest-only mortgage, which reduced their availability dramatically, as you can imagine, because most people didn't have the funds necessary to pay it off at the end. It was just a cheap way to get in the property ladder. So both these types of mortgages can be structured in a number of ways. The popular way of thinking of these structures is as types of mortgages that lenders can offer you. Let's see what they look like. This is the exhaustive list. As you can see, there are many of them. So let's choose the ones that are most relevant. Let's also focus on the ones which are a bit niche and often require additional qualifications for an advisor to be able to properly advise on them. Cap and collar. Let's imagine a room. If you bounce the rubber ball inside this room, the highest it can go is the ceiling and the lowest it can go is the floor. This is exactly what this mortgage looks like. You have a ceiling, which is the cap, but you also have a minimum below which the interest will not fall, which is the collar. And it could look something like this. The cap is 7% and the collar is 2%. So you're guaranteed the interest rate to bounce in between these two values and never leave this range. A discount mortgage, the interest rate charged for an initial period of the loan is lower. It's usually 1 to 2 years. The equivalent to this, I would imagine, is a savings account with an introductory bonus that ends after 3 months. You have foreign currency mortgages, where the capital and interest on the loan are designated in a different currency. Fixed interest ones remain the most popular ones, where you agree with your lender a fixed period of time where the interest cannot change, and it looks something like this. Flexible one, or variable, which is the most prominent one. Most of the mortgages are by default variable and flexible, with the ability to fix them for certain periods of time. A tracker mortgage might have been the most interesting type for the past decade. We've had low interest rates for the past decade, which means if you had a tracker mortgage, it's essentially a mortgage that follows the base rate and adds a certain fixed amount on top. It could look something like this, plus 2% over the base rate at all times. So if the base rate is 0, you're paying 2%. If the base rate is 10, then you're paying 2% on top of that. One of the most peculiar ones we will know about is the offset mortgage. This is by far one of my favorite types that remain little known to the vast public. Let's see how they work. Let's say your outstanding mortgage amount is £100,000, but you just happen to have £20,000 in cash. So by taking an offset mortgage, you could enter into an agreement with the bank whereby you leave your £20,000 in a savings or a current account, but you do not make any interest on it. However, here's where it gets interesting. The way they calculate your monthly payments is as such. They take the £20,000 and they remove it from the £100,000. So you're effectively paying interest on £80,000 of your loan. You don't get any interest on the £20,000. That's a negative. But is it offset by the fact that you pay less interest overall? On the category that we've mentioned earlier, where advisors need additional qualifications to be able to discuss these with their customers, the first one would be equity release. From the name you can tell why it isn't straightforward and easy to recommend as a range of products. Equity release is usually aimed at people over the age of 60 to allow them to release some equity or cash tied up in their home. They usually let people remain in the property for the rest of their lives or until they move into a care facility. These are quite tricky products that ought to be recommended in a very specific set of circumstances, only if no better alternative can be found. A last resort of some kind. There are two types of equity release schemes in the UK. Lifetime mortgages. These can be taken as a lump sum or a drawdown facility. There are many varieties under the lifetime mortgages umbrella, i.e. fixed repayments, interest only, home income plan. We don't need to get into any of those. However, because the target audience of this product is vulnerable and old, a clause is added on most of them to guarantee against negative equity. So the old person is never left on the hook for more than the original amounts. The second type of equity release is home reversion plan. Under this scheme, the client sells part of the home in return for a lump sum or regular income, sometimes both. The home reversion provider owns part of the house, but allows the client under a lease to live under its roof until they die or move to a permanent care facility. Since the company owns the property and is going to help the old person, the lease payments are usually of a symbolic value to the effect of £1 per month a lot of the time. Because of this level of facility, the client is usually paid a much lower amount than market value for their property. This goes anywhere from 20 to 60% below market value. The older they take the plan, the more money they get for their property. This is for life expectancy reasons, it makes sense. And because some clients in the UK follow particular faiths, which forbid them from dealing in matters where interest is involved, such as Islam for example, the following plans exist to accommodate the desire to buy a house without paying any interest. Examples of these are Ijara. Monthly agreed payments are held by the firm and used to buy the property at the end of the agreement. You've got another type that is called diminishing musharaka. And musharaka means participation. The firm buys the entire house and then rents it to the client. The rent payments decrease with every payment they make as the clients build a bigger share of ownership in the property. So the rental payments are equity building in this case. Enough of that. Some clients can find themselves in financial difficulties that require swift action to ensure consumer protection. In cases of this nature, some firms may offer to help by purchasing their home and renting it back to them for a fixed period. These are called flash sales, since they can take as little as a week, when the average property transaction takes up to 6 months. These rescue mortgages can be called rent back or sell to let schemes. As an advisor, you ought to be careful about recommending these sensitive products and making sure the client understands the consequences, as they will be paid far less than market value for their property. The rental agreement may not be as long as they would hope. The house may even be repossessed if the client's financial situation deteriorates further. Another famous kind of mortgage is buy-to-let, BTL. These come under two varieties, consumer and business. The business one is the most popular. Most of us have heard of it before. If someone wants to invest, they can buy a property and then rent it out and hope to turn out a profit. But for this type, you don't need consumer protection, because effectively you're not a consumer, you're engaged in behavior that resembles free enterprise, and therefore you are a business person in this case. On the consumer type, this is a protection measure regulated by the FCA, which was put in place to protect accidental landlords. What does this mean? Take the example where you buy a house with a normal mortgage and you receive a job offer in Australia. Exciting! In order to meet your mortgage obligations, you will have to rent it out. What you get in this case is a consumer protection measure whereby your mortgage can be converted from a traditional one, residential, into a buy-to-let, whereby you can rent it out and the payments can go towards building equity in the house. Other examples are people who inherit a property with a mortgage. They might not be in a position to afford their own mortgage and a new one, so they are afforded consumer protection where their mortgage can be turned into a buy-to-let one. Now then, let's delve into the two kinds of loans that exist out there. Any loan of any nature falls under one of these two. You have the unstructured loans. These are your mortgages, overdrafts, and commercial property loans. Unstructured means there's no defined amount of repayment at the moment of taking the loan. Repayments may increase or decrease, and usually there's little to no penalty for repaying the full amount at once. Think of mortgage repayments in this case. The interest rates attached to the loan is usually indicative of how risky the lender perceives the borrower to be. The second kind is the structured loan. These loans tend to be for smaller purchases. Think a phone contract, sofa on finance, or a car. This type has a fixed interest rate and a fixed repayment structure, which makes them easy to budget for. Let's take the example where you take out a phone contract for £30 a month for 24 months. Interest rates do not change throughout the life of this loan, and paying it back early attracts a penalty because the fixed expected profit that is agreed upon is harmed in this case. These loans are usually more expensive than unstructured ones since no collateral is required to be accepted for one. Focus point. Structured loans carry a higher APR or interest rate than structured ones, so you can realistically expect the interest rate on a loan to buy a car or a phone to be exceeding that of a mortgage most of the time.